Hello viewers, welcome to my channel. I'm Hasham. So now I'm continuing the problems on capital budgeting. So far 10 problems I have completed. In this video 3 more problems, 11th, 12th and 13th problem I'm going to explain. So after watching up to 10 problems, hope you got the complete grip on the problem. You understood the logic, the technique of evaluating the capital budgeting proposals. In examination, very frequently this topic will be asked because it's more real, practical subject, practical topic, that is capital budgeting. Investment decisions. Before making the investment, the business will evaluate what will be the consequence of this investment, whether it is viable or not to make the investment. So I have explained the complete theory in the video. So if you have not watched, go to the playlist of my channel, select the subject financial management for BBA, select the video of capital budgeting theory, watch the complete video, be perfect about the concept, about the techniques, and then you can easily understand the problems. So before starting the 11th problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. Always keep the problems ready. Take the screenshot of the points which I have written on the board. Then I'll explain. An investment required an initial outlay of 2 lakh rupees at present. This is the initial investment, PV of cash outflow. Cash flows from the investment are expected to occur from the end of second year at rupees 60,000 per annum. That means first year no cash inflows are there, only from second year onwards. Every year constant 60,000 per annum. These will continue to occur till 8 years of the project. The life of the project is 8 years. Up to the end of 8 years, every year 60,000. If the required rate of return is 19% on this investment, can the company invest in the project or not? It is not specified which method we have to apply. PBP or ARR or NPV, nothing is given. So whenever discount rate is given, it is better to apply NPV method. This is the absolute method of evaluating the capital budgeting proposal. Right? If the NPV is positive, we give the suggestion, accept the project. If NPV is negative, reject the project. And the discounting rate is 19%. So first of all, we calculate PV of cash inflow. So initial investment 2 lakh. Calculation of PV of cash inflow, year column, cash inflows are given in the problem. PV factors at 19%. These PV factors already have, shared the PDF of these PV factors in the description. Along with the questions, you take the printout of this PV factors table. In examination, you can carry this. Without having PV tables, it will be difficult to find out the PV of cash inflow. Otherwise, we can use the calculator also. In simple calculator, we can easily find out 1 divided by 1 plus r to the power of n. That is the formula for calculating PV factors. So 19%. First year, there is no PV of no cash inflow. The cash inflow will start from second year. So from second year to 8th year, 60,000. And the 19% PV factors are 0.706, 0.593, 0.499. All these values you find in the table. Multiply the cash inflow with PV factors. We'll get PV of cash inflow. Take the total of PV of cash inflow, 1,86,840. This is the PV of cash inflow. So PV of cash inflow 186,840 minus PV of cash outflow 2 lakh. Subtract. You will get negative. Minus 13,160. So I have not written the conclusion here. In examination, you should write here conclusion. The project should not be accepted. The project should be rejected because the NPV is negative. Our present value of cash inflow is less than the present value of cash outflow. Right? That is the decision. Now, 12th problem. ABC Limited is planning to invest in a project. The investment budget of the company is 40 lakh rupees. The company has the following alternatives, particulars, project A, project B. Two mutually exclusive projects are there. That means the company can either choose A project or B, anyone. Initial investment 25 lakh, 25 lakh. Both the projects, initial investment is same. Useful life, A project 5 years, B project 6 years. Cost of capital 10%. Cash inflows at the end of first year, second year, third year, up to sixth year. The cash inflows are given. Evaluate which project the company should select on the basis of net present value and the profitability index. The first time we are going to apply the technique of profitability index. It's very easy to calculate. But before that, we have to calculate NPV, net present value. So many problems we have calculated. The formula is NPV is equal to PV of cash inflow minus PV of cash outflow. Now here, calculation of NPV and PI, profitability index. Year 1, 2, 3, 4, 5, 6. Now PV factors are 10% rate. Again, refer the PV tables. Or you can use the calculator also, 1 divided by 1.1 like that. So cash inflows are A project 2 columns, B project 2 columns. In one table itself, I am going to calculate the PV of cash inflow for project A and project B. So cash inflows are given 5 years for A project. For B project, for 6 years, cash inflows are given in the problem. Now multiply PV factors, 0.909 into 5 lakh, 454, 500. 0.826 into 7 lakh, 578, 200. Take the total, 24 lakh 25,500. This is the PV of cash inflow for project A. Similarly, PV factors into 10 lakh, 0.909 into 10 lakh, 9 lakh 9,000. 0.826 into 6 lakh 50,000, 5 lakh 36, 900. Take the total, 26 lakh 6,000. That's all. So in the table, we have calculated PV of cash inflow. Now PV of cash inflow is 24, 25, 500, 26, 06,000. Minus PV of cash outflow, that is given in the problem, 25 lakh for both the machines, both the projects. So 25 lakh. So here negative 24, 25, 500 minus 25 lakh minus 74, 500. Whereas here 26 lakh 6,000 minus 25 lakh, 1 lakh 6,000. Now profitability index, PI. First time we are going to calculate profitability index. The formula is PV of cash inflow divided by PV of cash outflow. In NPV, we are taking the difference minus, whereas in PI, we are taking the ratio. That means PV of cash inflow divided by PV of cash outflow. So here you are having 24, 25, 500 divided by 25 lakh. You will get 0.97. Here 26, 06,000 divided by 25 lakh. You will get 1.04. That's all. So now, what is the decision according to PI criteria? According to NPV criteria, if the project has positive NPV, accept. Negative NPV, reject. But in case of PI, if the profitability index is more than 1, accept the project. If the profitability index is less than 1, reject the project. So here 0.97 is less than 1. So reject. Whereas 1.04 is more than 1, accept the project. So ultimate conclusion, according to NPV criteria and also according to PI criteria, both the criteria will favor project B, second project. That's it. So 12th problem completed. Now I am reading out the 13th problem. ABC Limited is considering an investment proposal to install a new control machine. The project will cost 1,50,000, expected life 5 years and no salvage value. The firm uses straight line depreciation. Salvage value, scrap value is nil. So 1,50,000 divided by 5, 30,000 is the annual depreciation. The estimated cash flow before tax, CFBT, from the proposal is as follows. That means depreciation already deducted. Before tax, we are having cash flows. So first year 30,000, 37,000, 37,500, 45,000, 45,000. You are required to compute the following: NPV at 10% cost of capital and profitability index. Just like the previous problem, we have to calculate NPV and PI. But the new point is profit before tax is given. That means cash flow before tax. Depreciation already deducted. Now, here cash flow before tax. Then we have to take the tax. Tax rate is not given in the problem. So it is assumed the tax rate to be 50%. So in examination, if something is missing like that, you write the assumption. In answer, you have to write the assumption. It is assumed the tax rate as 50% or 40. You can take any. So 30,000 into 50%, 15,000. 37,500 into 50%, 18,750. Like that, we have calculated tax. Deduct the tax. That means profit before tax minus tax. You get profit after tax. So 30,000 minus 15,000 is 15. 37,500 minus 18,750 is 18,750. These are the PAT. But for calculating NPV and PI, we don't require PAT. We need CFAT, cash flow after tax. That means CFAT is equal to PAT plus depreciation. We add back depreciation. How much is the depreciation? 30,000. So 15,000 plus 30,000, 45,000. 30,000 plus 18,750, 48,750. 30,000 plus 18,750, 48,750. 30,000 plus 22,500, 52,500. Like that we got CFAT. Now easily we can find out the NPV. Here CFAT just now we got it from here. And PV factors 10%. Already every problem I am telling that you have to consult the table, PV table and take. First year 0.909, 826, 751. It is given in the problem 10%. Now multiply 45,000 into 0.909, 40,905. Like this multiply CFAT with PV factors, you get PV of cash inflow. Add up. Take the total of PV of cash inflow 1,95,560. That is the total. Now PV of cash inflow minus PV of cash outflow, you will get 45,560. That is the net present value. Now profitability index. The formula for PI is PV of cash inflow divided by PV of cash outflow. So inflow how much? 195,560 divided by 1,50,000. You will get 1.30. So here NPV is positive and PI is also more than 1. So we give the conclusion, the project is acceptable. That is the end of problem number 13. So in this video, 3 problems I have explained. Still 2 more problems are there. That inshallah I will continue in the next video. So if you are satisfied, give a like to the video, share my channel, subscribe if you have not yet subscribed, and give the comment from where you are watching, which university you are pursuing your BBA course. It gives me more motivation so that I can be able to know who is watching from where. And do subscribe my channel. Inshallah, we will continue the next problem in the next video.